Good evening, everyone, and welcome. Federal Reserve Chair Janet Yellen went to Capitol Hill today. She told Congress's Joint Economic Committee that the U.S. economy is turning up after a winter of virtual standstill. But she pointed to several areas that bear watching, among them housing. Steve Leisman has our report.
Fed Chair Janet Yellen, in testimony before Congress's Joint Economic Committee today, blaming the first quarter's economic weakness solidly on the harsh winter weather and saying she already sees a rebound in spending and production in the first months of the spring. And that leads her to be optimistic about growth this year.
Looking ahead, I expect that economic activity will expand at a somewhat faster pace this year than it did last year, that the unemployment rate will continue to decline gradually, and that inflation will begin to move up toward 2%.
Behind Yellen's optimism, she sees less fiscal restraint. That is, a smaller decline in government spending, gains in home prices and equities leading to increased spending, firming foreign growth, and increasing confidence among business and consumers. Yellen cited geopolitical tensions and possible financial instability in emerging markets as the biggest risks to her forecast. She's also clearly concerned about recent housing weakness, suggesting it's a serious risk to the Fed's outlook. The new Fed chair, though, gave no hint that rates would rise any sooner than the market currently believes, which is about the second quarter of 2015. And she said the Fed remains on course to end its bond buying program or quantitative easing by the end of this year if the forecast for strong growth pans out. Several representatives peppered the chair with questions about whether the Fed's policy of keeping interest rates so low for so long are creating financial bubbles. Yellen said it's not a concern at this time.
Valuations are in historically normal ranges. Now, interest rates, long-term interest rates are low, and that is one of the factors that feeds into equity market valuation. So there is that linkage. So there are pockets where we could potentially see misvaluations in smaller cap stocks, but overall, those broad metrics don't suggest that we are in obviously bubble territory.
Yellen said there could be bubbles in high-yielding corporate debt or junk bonds, but overall, she said the financial system did not appear to be over-leveraged. For Nightly Business Report, I'm Steve Leisman.
For more analysis, let's turn now to Josh Feinman. He's Chief Global Economist at Deutsche Wealth and Asset Management. Josh, what was the key message from your point of view from Janet Yellen, and translate what her message means if you're an investor, a business owner, or someone looking for a job?
I think there's a couple things. One is she reiterated the point that the economy's weakness early this year was largely transitory. She expects the momentum to pick up as the year progresses, and the recent indicators have been supportive of that. But the other thing she stressed is that while we've made a lot of progress, there's still a long way to go to repair the damage that was done, particularly in the labor market, that there's still a lot of slack out there. And with slack still persisting, with wage pressures and inflation pressures very, very dormant, it's not a recipe for the Fed rushing for the exits.
Why is she worried about housing, Josh?
Well, recently, say over the last 6 months or so, the recovery in housing seems to have stalled out a bit. And that is a bit of a worry. But I think part of it is the weather. Part of it is a response to the backup in interest rates that we saw last year. I think going forward, we're likely to see housing continue or resume, I should say, its recovery. But if it doesn't, we get to the summer and it's not happening, I think that would be a concern.
So, Josh, I know that you're forecasting 4% economic growth for this current quarter that we're in right now, and yet you're talking about problems in housing, problems in the labor market. Where's that growth going to come from?
Well, some of it is just the makeup for the winter. We got no growth in the first quarter, so if we get 4% in the second quarter, that shouldn't be extrapolated forward as the underlying trend. Some of it's the makeup. What I think is happening, though, is the underlying momentum in the economy is picking up, and we'll start to see that more clearly as the year progresses. But the important point is, though, progress is being made. The labor market, as I said, still has a ways to go, and there's still a lot of slack. And I think that's why Fed Chair Yellen was reiterating the point that they're not likely going to be moving quickly to start renormalizing rates.
Where has inflation gone?
Nowhere. I mean, inflation has just been largely quiescent. It's below the Fed's target. And that's another one of the reasons that the Fed doesn't, the recipe is for patience. Because, they're missing both sides of their dual mandate still. Inflation is below target and we're below full employment. Both of those things would argue that the Fed shouldn't move quickly to start renormalizing rates.
All right, to use an overused word, the new normal, I mean, where do you see the unemployment rate going? Will we ever get back to full employment, roughly 5%? And where do interest rates ultimately go? What's the new normal on that?
I think that we will ultimately get back to something close to full employment. It's just going to take a while. We've gone now 76 months with no net job creation. Even using a conservative estimate, you probably need to create about 80,000 jobs a month to keep up with trend in the labor force. We've created 0 over the last 76 months. So that leaves us about 6 million jobs shy of what I would consider full employment. So if we continue to create jobs at 200,000 a month, it would still take us more than 3 years to get back to full employment.
Oh, wow. That's an amazing number to think of that. Josh, thank you so much for coming by. Josh Feinman.
Great to be here.
Chief Global Economist at Deutsche Wealth and Asset Management.